What's the exit strategy? If we buy this business and it's a $10 million deal, how can we sell it for 20, 30, 40, $50 million, right? Who's gonna buy it, right?
What about wholesaling businesses? And what about the prospecting method I see a lot of wholesalers use is using VAs and cold calling and things. Is that effective at all in the business acquisitions?
On a real estate deal, it's different, right? Real estate deals are all about cash flow, they're all about appreciation, because a real estate multifamily deal, it's like a static deal, isn't it, right? It's not living and breathing like a business. When all of the payments are going out on a monthly basis, does the cash flow from the business operation give you sufficient cover? And what we're doing on business deals is we want at least a 1.5x cover ratio, right?
So Carl, I've been a real estate investor for about 6 years.
Nice.
And you know what's interesting is when we got into deal making, at least when I did, there's so many parallels between real estate investing and creative financing and buying businesses.
There are.
Really, the idea of creative financing is just kind of the similar concept as a LBO, a leveraged buyout, right?
Yep.
Think about any real estate investors watching this. How easy is it to translate and leverage your experience into buying businesses?
It's very, very easy for a number of different components, right? So the first transferable skill is your ability to originate deals, right? So as you know, whether you're buying real estate deals or you're buying business deals, it all starts with deal origination, right? Deal flow, right? If you don't have opportunities, you're not going to close deals. So your prospecting skills as a real estate investor are going to translate very, very easily to business buying skills. And like with the real estate market, you know, there's only two ways you can really originate deals, right? You can go to the MLS, like Zillow or whoever, Redfin. The MLS in buying businesses is called Biz Buy Sell, and there's Transworld and all these other brokers, right? But we don't do that, right? That's not the smart way to do it. What we do is we originate off-market deal flow. And off-market deals are the kind of the holy grail. So off-market deal flow in the business buying world, we use direct approaches, we leverage deal intermediary network, and we leverage social media, right? So we're getting deal flow that's off-market. So there's no broker involved. You can go one-on-one with the seller. You can build incredible levels of rapport and build really solid relationships. And the higher that level of rapport and the more you can align your values to that of the business owner, the seller, then the more creative that you can get in terms of the deal structure and the price. So when you're doing deals, right, as a business buyer, I guess it's the same with real estate. One of the other things that's very relatable is there's only two variables you can control in a negotiation, right? You've got price and you've got terms, right? And as a buyer or a seller, you've got to pick which one of those variables that you want to control. So as a seller, you might say, hey, well, I'm fixed on my price, right? I'm not budging on my price. I want $4 million for my business, and I'm not going to negotiate on the price. But you as the buyer, you can control the terms. You can say, well, okay, your business is doing $800,000 a year in cash flow. You're valuing it at a 5x multiple. It's a little bit on the high side, but okay, it's doable. I'll do that deal, but I'm going to pay you over 10 years. So I'm going to take the $800,000 a year in cash flow. I'm going to give half of it to you as the business owner, and I'm going to take half as the new owner, and I'm going to pay you that $400,000 over 10 years, and that's the $4 million sell price, right? Whereas on the other side, the seller might say, hey, I'm controlling the terms. I need 90% of this deal paid at closing, right? If he's controlling or she's controlling the terms, you can then control the price and say, well, hey, if I'm paying you 90% at close, I've got to go and get, say, for example, an SBA 7(a) loan. And banks will only appraise the value of a business based on their lending criteria. So that's going to result in a much lower valuation. You might only get a 3x multiple or a 2.5x multiple. So it might only be like a $2 million acquisition, which the bank's going to support. So that's you complying with the seller's terms, i.e. I want 90% down at closing, or then you're controlling the actual price. So you can only control price or terms. So those two things are very, very transferable. And then what's also interesting, Chris, is the actual mechanics of closing a deal are again very, very similar, right? So when you're doing deals, either in real estate or in business, right, there are two things you do to close the deal, right? Once you've agreed the price and the terms and you put the deal under contract, in a business acquisition, that's called an LOI, a letter of intent, or a heads of terms if you're in England or Australia. What you then do is you have to do due diligence, and then you have to kind of execute on the legal contract, right? So on the due diligence side, when you're buying a business, you're going to check the tax returns, you're going to check the bank accounts, you're going to vet the balance sheet, income statements, and you don't have to do that right? A CPA can do that. And then the lawyer is going to check the title of the business, check there's no pending litigation, check all material contracts on all those different things, right? But now obviously on a real estate deal, your due diligence is a home buyer's inspection report, right? Does the thing have dry rot? Is it falling down? Are there cracks in the wall? Is it dilapidation? All those different things. Right?
Title searches.
Title searches. And so that's the legal piece then. There's a legal transaction to paper the deal to transfer the ownership of the real estate from the seller to the buyer. So there's so many different parallels, but what I would say is the biggest thing that I see that makes real estate investors super successful is that prospecting ability, that ability to go out and hunt for deal flow and then just flow through the rest of the transaction. That's the key. Clearly on a sub-2 real estate deal, you are taking over the liabilities inside of the business. In the real estate, you're taking the equity then that's left in the real estate, you're maybe paying some of that down, and then you're seller financing the rest. So I just bought a $700,000 house in Kissimmee. You've stayed in it.
Yeah.
That house was $700,000. There was a $500,000 mortgage on that house. So the mortgage has stayed in the seller's name. I just make the $2,900 a month payments, a pretty low interest rate. And then
It's a great payment.
yeah, and then the $300,000 that's left, is it $400,000? So the $300,000 that's left, I paid $50,000 down in cash, and I used my own money. Otherwise, I could have gone and got an investing partner and partnered with them on the deal. And then the $250,000 of equity that's left that I didn't pay for, I'm seller financing that over the expiry term of the mortgage, which is 29 years, right? So that's a really sweet deal for me because that house generates $9,000 a month in Airbnb. So after my fees and my management fees, that's generating around $7,500 a month in cash flow, and then less a $2,900 payment. So I'm cash flowing several $1,000s a month from that one house. Then I just bought another one, which is in Championsgate, which rents out for a little bit more per night. But that's early days, but that cash flowed net of everything, $3,200 just in August, right? Like, I'm not really doing this for cash flow. Yeah, the cash flow is good, right? But you got to buy hundreds of these, to really make significant income. But what I'm betting on is like the long-term appreciation play, right? So like I could do these deals even if I didn't cash flow, even if all my costs were covered, right? I'm still going to get equity increase. And bearing in mind, I'm doing these deals at least 10 or 20% like below market value, right? So I'm instantly getting equity the day I close that I don't have to pay for.
But how does that translate to business? Can you do the same thing?
Yeah, so you can do this exact same thing in business, right? So let's say you find a business and it's doing $300,000 a year in cash flow and the seller wants a 3 times multiple, right? So that's a $900,000 acquisition, right? But then let's say that business has got $500,000 of liabilities already inside of it. So taxes due, if it's a B2C, it might have payables, it might have a bank loan, it might have been acquired through like an SBA loan, or it might have EIDL loans or all those loans inside of the business. So you can buy that business subject to that $500,000 of debt. So really then you're paying $400,000 for the equity in the business. And let's say you put $100,000 down, you go and get an investing partner, or you can finance some of the assets on the balance sheet. And then the other $300,000, you can sell or finance that, right? That's a perfect example of a sub-2 deal. When you're buying a business, you're putting in some equity, it can be your money, or you can syndicate that with other investor partners, or you can get a line of credit from the business, or you can leverage some other assets on the balance sheet, and then you're seller financing the rest of the equity, and then you're taking over the existing liabilities that are already inside of the business. And it all comes down to debt service cover ratio, right? When all of the payments are going out on a monthly basis, does the cash flow from the business operation give you sufficient cover? And what we're doing on business deals is you want at least a 1.5x cover ratio, right? So for example, let's say you're doing a smaller deal and that deal's cash flowing $150,000 a year, and then it's going to cost you $100,000 a year in debt service to pay the seller, to pay the loans, to pay all that stuff, then you want at least a 1.5x cover ratio, and then that's going to give you enough wiggle room, enough headroom to deal with seasonality in the business, any bumps in the road. If something goes wrong, That's kind of the magic number.
So I've heard some other examples recently of some students in our program who came from sub 2. They're actually targeting businesses that have lease payments. And usually leases on commercial are 3, 5, 7 years.
Yeah.
And there's a lot of business owners that are really burnt out. They want to get out of the business. Yeah. And that lease payment is their biggest liability.
Yeah.
There's ways to literally go in there and take over their lease payment subject to, take over the business almost at no value, and be able to continue on operating that business. And it's just amazing. So let's switch over to wholesale, right? So wholesalers are kind of a whole different breed. They're real scrappy. They're able to make money with almost thin air, paper flipping. What about wholesaling businesses? And what about the prospecting method I see a lot of wholesalers use is using VAs and cold calling and things. Is that effective at all in the business acquisitions?
It's not really, no. But in business acquisitions, like, you're doing the same amount of deal origination. So you're going for off-market deals through social media, through direct approaches, through leveraging a deal intermediary network, CPAs, attorneys, wealth managers, etc. So you're still doing the same deal origination. And then the goal is you go and get that deal under contract, right? So you agree, typically like on an annuity deal. So let's say you find a business, it's doing $400,000 a year in cash flow. The seller wants a 2.5 times multiple, which is $1 million. They'll let you pay for that deal over 10 years. So it's $100,000 a year. So no external financing at all. Maybe you're assuming some of the liabilities in the business as well, but you're contracted to pay the seller $100,000 a year in cash flow, right? Now let's say that business is not in your lane. You don't want to take ownership of that business, right? If it's cash flowing $400,000 a year and you've only got to pay $100,000 a year to the seller, you've got $300,000 now of surplus cash flow. So as a wholesaler, what you could do is call somebody like me or any of the other buyers in our program and say, hey, I've got this deal, right? It's cash flowing $400,000 a year. The seller's going to take 100. I'm going to take 100 as the wholesaler, and then the business is going to keep $200,000 for you as the new owner. So as a wholesaler, you could make $100,000 a year. You could make the same amount of money as the seller just for wholesaling a deal, yet you never have to go anywhere near that business, right? And if you're wholesaling real estate, what do those guys make? 10K? I know when I bought one of my sub 2s, the entry fee to pay the wholesaler was, I think it was $15,000, right? So you can make $15,000 one time as a wholesaler on a real estate deal, or you could make $1 million over 10 years just wholesaling one business deal.
So just having the skill set of deal origination, finding off-market deals,
huge, man.
Which is what these real estate investors are doing anyway. I mean, there are some strategies where the MLS is the main focus, but going off-market is the holy grail in real estate investing, just like in business.
One of the challenges with business broker deals, right, is if you want to get really super creative in the financing structure, the seller may be open to something like that. But the problem is, on a business acquisition, the broker wants to get paid, at the closing table. The brokers can charge between 5 and 10% of the sales price. So let's say on that $1 million deal, the seller says, great, I'm happy to take $1 million a year for 10 years, right? And the broker, let's say he's on a 10% fee, he wants $100,000 cash at close. Now, if that business doesn't have that cash inside of it, then the deal's not going to work. The broker's going to talk the seller out of that deal, and he's going to continue to go out and find a buyer that's going to pay, maybe $500,000 at close or $700,000 at close, and then seller finance the rest. So wholesaling deals and annuity deals work really, really well when the deal's off market. Number one, there's no broker that you've got to pay at the closing table. But then number two, it's a lot easier to go one-on-one and build that really deep level of rapport and relationship. And then there's no broker kind of talking in the ear of the seller and talking them out of that transaction.
Same parallel in real estate with the real estate agents, the realtors. They're really blocking a lot of deals and they think they're protecting their client when they're really not. There's so many different ways to structure deals that could be better for the client. And it's just like a broker. They block it and make it difficult. They even tell their clients and you, this is absurd. No one does this, and it really hurts the ability to make a deal happen. So last thing, and we can wrap this up, quick question. Multifamily investors, I've hung out with a lot of them, and what they're good at is raising capital. They're good at going out, finding people to join in on the investment. Many hands make light work. They put up money together and they buy these big old properties that are cash flowing, through a syndicate. How does that translate over to what we're doing and what you call big boy pants deals?
So exactly the same in a big boy pants deal. So when you look at a big boy pants deal, so let's say you find a business and it's doing $2 million a year in cash flow, right? So it's cash flowing like crazy. And typically at that level, you're gonna pay probably a 5 times multiple to buy that business. So that's a $10 million deal, right? Now, typically the bank is gonna give you between 2 and 3 turns of that cash flow in debt financing, right? Let's say you go and raise $6 million in debt on that deal. Sorry, $6 million debt line, right? So now you've got $4 million to find. Now let's say the seller agrees to $3 million deferred payment, a seller note, right? So you've got $3 million in seller financing, you've got $6 million of debt financing. Now you're only $1 million shy of actually closing that deal. Let's say 1.5 million to include working capital and closing costs and all those other things. So you need a 1.5 million bucks. So what you can then do is, if you have no money, you can go and sell equity in that deal to investors, right? They could be angel investors. You can go to the angel investment syndicates. They could be friends and family. They could be family offices. They could be micro private equity funds. They can be hedge funds even. There are lots of people with equity that want to buy part ownership in these deals, right? They're not going to give you equity kind of pari passu, which means like on par. So let's say you needed $1.5 million of equity on a $10 million deal. That's not you selling 15% of the deal. They're going to want at least double that. So you might have to sell 30 or 35% of the deal to raise that $1.5 million of equity. But then let's say you do that, you now own 65% of a business that's cash flowing $2 million a year before debt service, and you haven't put in a single dime of your own money. It's crazy. So yeah, syndicating investment from equity investors is really, that's where the big boy pants deals happen. It's exactly the same in multifamily. And at the end of the day, right, when you're pitching an investor, right? So I used to be a private equity investor. I used to do this for a living, right? I used to get pitched 100 times a week on deals. So what's really cool about pitching investors is there's only 5 things that an investor really cares about on a business deal. On a real estate deal, it's different, right? Real estate deals are all about cash flow. They're all about appreciation, because a real estate multifamily deal, it's like a static deal, isn't it, right? It's not living and breathing like a business. So when you're pitching an investor on a business deal, there's only 5 questions that are running through their head when they hear your pitch. And most people pitching for equity, they don't answer these 5 questions in their pitch. So question number 1 is, right, what's the big idea? What's so unique about this business that it's worth somebody buying? So what's the big idea in terms of the opportunity? What's the business? How is it differentiated? What value is it providing to its customers? Is it what I call a painkiller deal or a vitamin deal, right? Or a vitamin deal. The second question they're going to ask is, what is the strategy to grow this business and generate returns? So if I'm an investor and I'm buying in at the current valuation, if I need 3 to 5 times my money over 5 years, what's the strategy to make that happen, right? So what's the growth plan? What's the marketing? How do we get more customers? How do we sell more to them? How do we do all that? Do we need to do bolt-on acquisitions? Do we need to buy into our supply chain? Do we need to buy out competitors? You know, what's the actual plan to get the business large enough and profitable enough so that we can sell it and we can make 3 to 5 times our money, right? That's the second thing. The third thing, really, really important. Who's the team behind the deal? Can the team execute on that strategic plan? I know the big idea, I get it. I like the strategic plan, that's doable, right? Does the team have the chops to make that happen? Can they execute? Can they deliver that growth, right? That's the third thing. Number 4, what's the exit strategy? If we buy this business and it's a $10 million deal, how can we sell it for 20, 30, 40, $50 million, right? Who's gonna buy it, right? Who are the trade buyers in the market that when it gets to a sufficient size, they're going to be salivating over this deal? It could be a trade buyer that wants to enter the market, like when Amazon bought Whole Foods to get into the grocery market, or is it a competitor just looking to increase market share and buy up the competition in the neighborhood? Who's going to buy it? Could be a family office that buys it. Could be a PE fund that's doing a big roll-up, right? What's the exit strategy? Who's going to buy it and why? And then how does that impact how we behave and who we are in the market? Do we need to go and give someone a bloody nose in the marketplace, so then they'll come and they'll take us out for a big multiple, right? So that's the exit strategy. And number 5 is, once you've figured all that out, what's, as an investor, my risk-adjusted return on investment? If I'm looking for a 10x return on my investment, then I'm prepared to take a much riskier deal. Whereas if I'm only looking for a 2 to 3 times, if that's my investment thesis, if I'm only looking for a 2 to 3 times return, then I want a business that's really a no-brainer. A lot of bad things are going to have to happen for this not to work, right? So those are the 5 things that investors are going to look for in a business acquisition. And I think there's some parallels to that in the real estate world and the multifamily world. But multifamily is a static thing, right? It's not living and breathing like a business. And a business can scale value-wise considerably faster than a piece of real estate.
Yeah, I think in multifamily, they usually have to go in and renovate all the different places to really increase the rent roll and make the exit larger, where there's a lot of costs associated with that. And it's almost baked in the deal. With businesses, it's a lot different. So if you're a real estate investor and you're watching this, there are literally thousands of investors who are shifting focus and also buying cash flowing businesses, not to stop what you're doing, what you love in the real estate business, but also to do this as well and make a lot more money per deal with businesses and be able to feed that back to your real estate investments. And that's what literally thousands and thousands of investors are shifting over. We have so many.
Every time we take distributions, what do? We invest
buy
in
houses.
real estate.
Yeah, that's it.
It's not rocket science.
So if you're interested at all in learning about how you can leverage your real estate investing experience to buy cash flowing businesses, we'd love to teach you. We have a link in the description, or we have a link down below where you can watch a masterclass on how you can leverage your real estate investing experience to buy cash flowing businesses and even work with us and partner with us on deals.
Yep, awesome. And it's free. So go check out the link, go watch the masterclass. And if you've got any questions, hit us up. I'm at Carl Allen Official. This is at Chris Moore Speaks. We'll see you guys soon. Thanks for watching. Until later, bye for now.